September 15, 2008. The world woke up expecting an ordinary Monday. Traders walked into Wall Street offices carrying coffee. Investors checked stock prices. Families prepared for work and school. Everything looked normal. But beneath the surface, a financial earthquake had already begun. Within hours, one of the largest investment banks in American history would collapse. Markets would panic. Billions of dollars would disappear. And millions of people around the world would eventually lose jobs, homes, savings, and retirement funds. But here's the strange part. The crisis didn't begin that day. It didn't begin in 2008. It didn't even begin in 2007. The seeds of disaster had been planted years earlier. In quiet boardrooms, in mortgage offices, in spreadsheets filled with numbers nobody fully understood. While the world celebrated rising house prices and record profits, a hidden machine was growing larger every day. A machine powered by debt. A machine that looked unstoppable. A machine that was quietly preparing one of the greatest financial collapses in modern history. And almost nobody saw it coming. So the question is, was the 2008 financial crisis truly a surprise? Or was it a slow-motion crash hiding in plain sight? To understand the crash, we need to travel back to the early 2000s. America was feeling optimistic. The technology bubble had burst a few years earlier. The economy had slowed. But there was one sector everyone believed in: housing. For generations, people had been told that buying a home was the safest investment possible. Stocks could fall. Businesses could fail. But houses? Houses always went up. Or so people believed. Banks believed it. Investors believed it. Politicians believed it. And ordinary families believed it. As confidence grew, mortgage lending exploded. Banks began offering loans to more people than ever before. At first, this seemed like a good thing. Families who once couldn't afford homes suddenly had access to credit. Neighborhoods expanded. Construction boomed. House prices climbed year after year. The system appeared healthy. But beneath that prosperity, something dangerous was changing. Traditionally, banks would issue a mortgage and keep it for decades. If the borrower failed to pay, the bank suffered the loss. That created discipline. Banks had to be careful. But a new model changed everything. Instead of keeping mortgages, banks started selling them. Thousands of loans were bundled together and transformed into financial products. These products were then sold to investors around the world. Suddenly, banks no longer cared as much whether borrowers could repay, because the risk could be passed on to someone else. The incentives had changed, and nobody realized how dangerous that would. Imagine a bakery. Normally, a bakery sells bread. Simple. But imagine a bakery that starts selling promises instead of bread. Promises that bread will be delivered in the future. Then those promises are packaged together and sold to investors. Then those investors sell portions of those promises to other investors. Soon, the market becomes less about bread and more about trading promises. That is essentially what happened with mortgages. Banks issued loans. Those loans were bundled into securities. Investment firms sliced those securities into different layers. Rating agencies examined them and often labeled them extremely safe. Many received AAA ratings, the highest rating possible. To investors, AAA meant security, reliability, trust. But there was a problem. The underlying mortgages were becoming increasingly risky. Many borrowers had weak credit histories. Some loans required little documentation. Others offered low introductory payments that would later increase dramatically. Yet despite these warning signs, demand continued growing. Because everyone believed housing prices would keep rising forever. As long as prices rose, problems stayed hidden. Defaults seemed manageable. Losses appeared small. Profits looked enormous. Banks earned fees from creating loans. Investment firms earned fees from packaging them. Rating agencies earned fees from evaluating them. Everyone was making money. And when everyone is making money, very few people want to ask difficult questions. The machine became larger, faster, more profitable, and more fragile. Like a giant skyscraper built on unstable foundations. From a distance, it looked magnificent. Up close, cracks were already forming.